Hello, everyone. Welcome to the Green Bonds for Climate Resilience, Unlocking Trillions for a Resilient Future session. We're very glad to have you here with us today. We would like to start by thanking our sponsors, JP Morgan, Credit Suisse, Ping An, Moody's ESG Solutions, Luxembourg Green Exchange, Citi, Refinitiv, BNP Paribas, IHS Markit, Alliance Bernstein, FSD Africa, Inter-American Development Bank, ECMA, Mizuho, IFC, and Ashurst. Before we start, just a few important reminders. Q&A box to ask questions, other comments or queries to the chat. We have live interpretation in Portuguese, Spanish, Mandarin, French, and today we also have Japanese. You can look for the headphone icon. All sessions are being recorded and you can listen to them until November on Swapcard. Please use the tools on offer to network with thousands of attendees and check our virtual booths. For media interviews, please visit the Climate Bonds virtual booth to arrange it. Many thanks for our presence and enjoy. And over to Joyce now to introduce our amazing speakers.
Thank you so much to the Climate Bonds Initiative and welcome everyone to the Green Bonds for Climate Resilience, Unlocking Trillions for a Resilient Future. I'd like to start by introducing an extraordinary panel today. First, Nazmira Mula, who is the head of South African investments at 91. 91, many of you should know. It's a global investment manager offering active strategies across equities, fixed income, multi-asset, and alternatives to institutions, advisors, and individual investors around the world. Nazmira works on broader sustainability initiatives for the company and is passionate about making financial markets work to support development, as you'll hear shortly. She was previously co-head of Africa Credit, where her remit included the Emerging Africa Infrastructure Fund. Also, Isabelle Laurent is the Deputy Treasurer and Head of Funding at the European Bank for Reconstruction and Development, EBRD. Isabelle oversees EBRD's issuance in the capital markets and investor relations and focuses on capital markets development in EBRD's countries and operations and sustainable finance. For several years, Isabelle has been fully engaged in the work of the Green Bond Principles as a member of its executive committee and as co-chair of the GBP's Impact Reporting Working Group, which you'll hear more about today. In addition, Maria Tapia is the climate finance lead at the Global Center on Adaptation. GCA is a new international organization focused on setting the agenda, doing research, and creating a continuum for advocacy to research and implementation. As the Global Commission on Adaptation ended its mandate in 2020, now GCA moves forward that mandate as a solutions broker. If someone is perhaps not muted, it would be great if you could do so. Thank you so much. Now, GCA is bringing best solutions and reducing the finance adaptation gap by partnering with the best of the best, including CBI. And they are currently expanding partnerships in Africa and Southeast Asia, and they want to increase different types of instruments for adaptation and bonds, which is part of what they'll help to share with us today. And finally, Stacey Swan is the CEO and founding partner of Climate Finance Advisors. Climate Finance Advisors is a Benefit LLC and is a mission-driven, women-owned consulting and advisory firm working to accelerate sustainable, climate-aligned investments to benefit society, the economy, and the environment. They work to integrate climate resilient considerations into infrastructure and bond structures, and their key focus is resilience, in addition to greenhouse gas reductions. CFA is known for many, many things, including identifying, assessing, and risk reduction benefits for asset owners so that they can raise funding and financing. Stacey has more than 2 decades of experience in financing and fund management and in development, including with the International Finance Corporation, where she was head of IFC's blended finance unit and was responsible for managing the investing more than $750 million in donor funding for climate smart investments. So real pioneers on the bleeding edge of resilience finance with us today. My name is Joyce Coffey, and I'm the president and founder of Climate Resilience Consulting, a social enterprise based in the United States that works with clients to create practical strategies that enhance markets and communities through adaptation to climate change. I was also privileged to be the technical lead of CBI's Adaptation and Resilience Expert Group that created the Climate Resilience Principles, which we may speak about a little bit more today as well. So As we get started and as we pivot to the content of our session today, I do want to remind you, as we heard earlier, we are eager for your questions and we encourage you to include them in the chat. Our colleague Ujala Kudir will be connecting some of those questions together, and we should be addressing them in about 20 minutes after we've gotten through some of our introductory remarks. And perhaps to start, we need to remind ourselves that COVID-19 has really indicated that shocks can cascade and compound in complex ways with broad economic and social implications. And with record-breaking intensity and numbers of extreme weather events in 2020 and 2021 alongside this pandemic, it has become clearer than ever before how acutely vulnerable we are to the cascading and multiple shocks that we face. The impacts of climate change are undermining progress on the Sustainable Development Goals, reversing many of the gains made over the last decade that have typically been improving people's lives. So creating a resilient society requires massive investment and redirecting vast sums of capital towards adaptation. But there is a huge investment gap. And this gap is often cited at around $300 billion annually by 2030 for developing countries. But when accounting for developed countries, as well as mainstreaming resilience to decrease physical climate risks to all existing and future infrastructure, the adaptation gap is likely to be on the scale of trillions rather than billions annually, which is why we've titled this session with that T. So this represents a significant investment opportunity, and it is also an opportunity to save lives and improve livelihoods, even in the face of this extraordinary disruption. Today's session explores how we can leverage one of the most prominent innovations in the area of sustainable finance, green bonds, as a tool for directing capital towards adaptation and resilience. So I'm really pleased that we'll be able to hear from these extraordinary leaders. And I'd like to start with a question for everyone. What do you think is the single biggest trigger for scaling up resilience investments? Maria, would you like to kick us off?
Sure. Thank you, Joyce. And thank you, everybody. Thank you, CBI, for the invitation. I think before I able to answer that first question, I need to set the ground of what is really the gap and how we need to engage with the private sector. So I have good news. The global investment in adaptation has slowly and steadily increased from 22 billion in 2015 and 2016 that it was tracked to 30 billion. The bad news, obviously, is that it's not enough, and you already put out the figure of 300 billion per year by 2030. So we need to increase 5-10-fold to meet those investment needs. In particular, the private sector must become more engaged. Private sector funding for adaptation accounted less than 500 million in a year. This comes very short to the 30 billion that it's needed. So only state and multilateral expenditure will not close that funding gap. And we need to further work with local financial markets and develop those markets in developing countries to unlock this domestic fund for adaptation and resilience investment. Now, another good news is that there's an investor demand on thematic bonds. And we saw during the pandemic the increase of thematic bonds in the format of use of proceeds to attend COVID emergency. Most of them, obviously, they were social bonds. But we are not here to talk about social bonds. We are here to talk about resilient bonds. I'm going to give you some facts that we just published in one report that we will share in a link through a link that it's called Green Bond for Climate Resilience. We did this report in partnership with CBI and EBRD. And from that report, I'm going to share these facts. So from the green bonds, the labeled green bonds that are already there, 16% of those green bonds already include adaptation and resilience activities, mainly on water sector and wastewater, but we have already those type of activities in green bonds. Now, from these, 79% of these issuances came from developed markets, 15% from supranational institutions, and only 6% for emerging markets. So there's a lot more to do in emerging markets. With respect to issuers, 12% of these bonds were issued by sovereign and local governments, 65% by government-backed entities, 16% by development banks, and we will listen to Isabel from EBRD as they were the first institution issuing a 100% resilient bond, and then 4% by financial corporates and 3% by non-financial corporate organizations. So to answer what is that we can scale, it is not one thing. I think, and in this report that I mentioned about green bonds for climate resilience, we put 3 priorities. The first one is to build momentum. Most of the MDBs, most of the international cooperation had made huge effort to pledge or allocate or increase their allocation of climate finance for adaptation. World Bank set out a 50% allocation of climate finance for adaptation. We have announcement from bilateral governments, also putting money putting extra resources for adaptation. The African Development Bank, we are in partnership with them working on a 25 billion adaptation accelerator program with them. So we need to use that international cooperation very wisely. We need to use it in technical assistance, to structure new bonds, to identify project pipelines, to blend resources. We need also to safeguard the credibility of these bonds. So we need to work more deeply in the metrics to report and how we track those investments so that investors will be able to say, I'm aligned to the net zero or I'm aligned to Paris Agreement, but here is the way I report and here are the metrics. So we need also to scale, and to scale we need to again use international cooperation to support governments to put out their robust adaptation, national adaptation plans. We need to establish mandatory climate risk and disclosure targets for sectors. So there's no single thing to do. And I think that through this panel, we will come up with most precise recommendations of what more we can do. Thank you.
Thank you, Stacy. I know that you have a huge amount to say about some of that. Can you share a little bit more on the sovereign end and some of the research that you've done?
Yeah, for sure. And thanks, Maria, for setting that stage also. We're actually, in terms of your question about what we think is going to be an important trigger for kind of accelerating this space, we're seeing something which I think is going to have a huge impact very quickly across all of the parts of the financial sector. And that is that, we're starting to see climate-related risks, climate-related financial risks show up in backwards-looking research in bond spreads, and in particular in sovereign bond spreads for emerging markets. Now, that might not sound like a great thing, but what it tells me is 2 things. One, we have the ability now for rating agencies and other parts of the financial sector and investors, of course, to start quantifying climate-related risks and start asking for resilience, right? And potentially, again, this is kind of forward-looking now, but potentially also starting to think about how to incentivize resilience, whether it's a bond issuance or just other kinds of corporate or debt financing. Incentivize the resilience measures that we all know that we need. I mean, Maria essentially outlined, the amount of work to kind of create climate adaptation and resilience infrastructure and communities and things like that is enormous. And we have to make every dollar work towards those goals. But now that we have started to see the capabilities to start quantifying climate-related risks in financial terms, And we're starting to see it show up in bond spreads historically. Again, some of this data and research is only kind of coming out in the last year to 18 months, but it's all backwards looking, which means, the capabilities are there for rating agencies to start thinking about this in real ways. That to me is pretty exciting because that can cascade through all kinds of asset classes pretty quickly. If you've got that capability, it can start to integrate into kind of how we finance things pretty fast. Now, there's an asterisk on there because everybody who's in this space is watching the data and analytics space, and some people have questions. And of course, the metrics and methodologies are still evolving. But for me, any forward progress is good forward progress. We all know we have a lot to kind of improve upon, and the perfect is the enemy of the good here because we've got no time. So I'm pretty enheartened that this is starting to become usable by investors. And the last thing I'll say before maybe moving to the next speaker is that part of the reason why I think this is happening is because of things like the Task Force on Climate-Related Financial Disclosures, which has done an enormous amount of it's had an enormous impact on all kinds of things in the financial sector, of course, in emerging markets. And for the development finance world, this has become kind of a really important framework to essentially help us start to accelerate investments for the emerging markets and countries that may not be as well positioned as developing markets. But it's also started giving investors a language to start asking about these risks in their own work. And I think that's also really important. Awareness is raising and rising fast, and understanding, while not at the same level as awareness, is also rising fast, partly because of the ability to quantify these risks. So maybe I'll stop there. I do think for the moment, the folks who are doing the issuances here, and it might be useful to turn this over to my colleague from EBRD. That's where really the real hard work has to happen, and I'm excited to hear from her.
Great. So Isabel, give us that scoop. I mean, because you have actually done the issuance. This is not theoretical for EBRD, and therefore it's not theoretical for the market. You've set the bar. Tell us how that happened.
Thank you. And now I feel like I'm almost bound to disappoint with a decent build up from two. But I think, just answering your question very quickly as well, the initial question of what's the single biggest trigger, which feeds into our experience. I really think it's all the vulnerabilities that we've been seeing. We've been seeing the wildfires, we've been seeing the temperature rises, we've been seeing all these different extremes. Even COVID's relationship to environmental issues. And I think that it's the fact that people now start to understand that the sort of economic and social disruption that we're seeing won't be resolved by climate mitigation alone. All the efforts that we're putting into that simply aren't going to do it. We're still going to see the effects, and therefore climate resilience, climate adaptation are really important. And this was something that we really thought about highlighting through issuing the first climate resilience bond, because it had very much been treated as the poor relation to climate mitigation. So, if you look at most of the green bonds that have been issued, they were focused on renewable energy, energy efficiency, and there were a few other things, water, transport, buildings, and so on. But the climate adaptation elements, rather than the energy or water savings or carbon reduction, was simply not the major focus. And even in some investors' assessments, you could see that they considered them light green rather than deep green. So there was this idea that they were of secondary importance. And I think that all the dramas that we've seen, plus, as the last speaker said, discussing TCFD, the fact that we're having to analyze what are the risks in our portfolios, actually is incredibly helpful in trying to understand that this is something that we really need to address, and that we're going to be asked to address by rating agencies and investors and others if we're planning to go to capital markets. I think when we were looking at the assets, it was interesting, we were ourselves somewhat to blame, because although under our green bond program that we'd had since 2010, climate adaptation projects could be included, we had very little that was solely focused on that, or even partially focused on that. That again was sort of shifted down the line. And one of the things that we needed to think a bit about were the what to put together within the framework that was different than our the framework that we'd had for our general green bonds. So we were thinking about some of the age-old debates that we've been having in the green bond principles about capex and opex, because there are certain things that are slightly harder in relation to climate resilience if you are not focusing on operating expenditures as well as capital expenditures. So in our framework for climate resilience bonds, we were focused absolutely on that. Because it was tied in with CBI's release of the climate resilience principles, it was very helpful for us to think a bit about some of the different aspects. I mean, the definition of what was intended, the scope of the kinds of projects that we were focused on, infrastructure, agribusiness, the sort of areas that were really quite important and much less of a focus on our normal green bonds, as well as the sort of business and commercial operations, which were definitely part of what we were focused on for the climate mitigation side. So I think it was really that shift, and then trying to think through the metrics. I mean, I don't want to go on too long so that we all get a chance to discuss other things, but happy to go into any different aspect of that. But that was the sort of driving force for issuing the bond, and then trying to talk to investors about why we were doing it in this way, highlighting climate resilience bonds as a sort of separate part of the green bond principles, fully aligned with the green bond principles and with the climate resilience principles, but why it was done separately rather than just, you know, tweaking our existing program to facilitate it.
Great. Well, thank you so much. And yes, we probably will come back to you around metrics. But now I would like to turn to Nesmira, because we've talked about the investors and we talk about the capital markets. And now we have an investor who is in the capital markets and influencing her peers. And we'd love to understand better, what are you seeing in terms of resilience as an investment portfolio?
Thanks, Joyce. I think that, not surprisingly, we're not seeing massive deal flow on resilience specifically. You see pockets of it built into other bonds, but even when it's there, often that's not being consciously bought as resilience. So, for example, just before the session, I was on the desk talking to a colleague. Now that we managed to go back into real offices every now and again, and he was talking about a green bond that he's just bought from the Queensland government. And I looked at it and I said, "Oh, you've got a resilience element." It's like, what? What are you talking about? And there was a water element and it was water strengthening. And the knowledge level is not very high amongst investors, is my first point. And therefore, this concept of climate mitigation and carbon mitigation and adaptation are well heard, but I don't know if the adaptation and the consequences of what that means are actually well understood, particularly when it comes to buying the bond. And then when you talk about buying the bond in emerging markets, it's even more of a foreign concept. So I think my key message is awareness beyond the theoretical is very low. And the more that we can do around that to make it much more tangible, the more there will be appetite. Because what we are seeing is the growth in sustainability mandates, the growth in desire from end clients, for the asset owners themselves, whether that's the pension funds or the insurers or the retail investor, to have much more in the way of green bonds in their portfolios, to be doing something tangible on climate change. So I think there's demand from the end investor, provided we can demonstrate how that is the case. And maybe the last place I'd end is where Isabel ended, is metrics. Is the importance of metrics that are understood and clearly understood and can be monitored on an annual basis really should not be underestimated, because I think there is a fatigue with greenwashing, as we all know. And therefore, this can't be just an attractive label that is used. It needs to be tangible. And I think the climate resilience principles go a long way to achieving that, but it all culminates in those metrics.
So we've heard so many interesting ideas, right? The climate risk dramas was a word that someone used. The bond spreads and how they are impacting this real trigger towards more demand for resilience bonds, TCFD, and even metrics. But we also are understanding that there is still a giant knowledge gap. So I'm going to be asking in a moment what decision makers, policymakers, and others really need to do in order to support the issuance of resilience bonds. And I'm asking for you to actually be giving advice to other sectors. So maybe you have some advice for your own sector, but also other sectors. Before I do pivot, though, I wanted to point out one other element that I'm seeing certainly in my work as a potential trigger for scaling up resilience investments, and that is the erosion of the middle class market. What we know for sure is that climate change is not fair. And although many of us on the call can speak in terms of the future of climate risk is here for the vast majority of impoverished people around the world, whether they're in developing countries or in OECD countries, literally in neighborhoods several miles from where any of us sit. And so when we think about what it means that the social safety net is going to need to be so much stronger, and that the economy may actually have some knock-on effects from these impacts on the poor, I think we might also imagine not the single biggest trigger, because the poor rarely trigger anything in the markets, but one major trigger for an uptick in resilience-based investments is the quest to ensure some stability in middle-class markets that, like we have enjoyed for the last decade or so in many countries. So, but before we move into some of perhaps these questions about metrics, which I do hope to come back to, I'd really like to focus on this point that, Nazmira, you've made so well, which is that we still have a lot of knowledge brokering to do. And I wondered, maybe actually even Stacey, if you could pick up on that, especially with regard to the work that you're so familiar with vis-a-vis rating agencies, the pension funds, and others.
Yeah, I think this issue that was pointed out about the gap between awareness and understanding is really important to kind of to table, right? And I think there's some reasons why awareness is rising and understanding is still so low. Awareness is rising partly because we now are starting to see the effects of climate change. I mean, mainstream investors, the development world and the development finance world has been kind of seeped in this for 20 years or so, but the Main Street investors are really, we're kind of thinking of climate change even 5, 6, 7 years ago as an add-on or an incremental thing. And the acceleration in the last couple of years, actually, in the desire for by those investors to start looking for things that are more sustainable, ESG related, that kind of thing, has kind of only come about in the recent couple of years. But part of what's happening, and I think this is a function of us being in the very early days of having the toolkit, meaning the metrics, the ways to assess, the methodologies, even disclosures, early days. I think part of what we're seeing is awareness is rising for various reasons, whether people think of it because they're investing in emerging markets and some of their, some of the other investors around the table prioritize resilience and adaptation, or because they themselves have gotten the climate bug and understand that we've locked in enough warming that we're going to have to address these things, or because they actually have some value at risk in an existing portfolio. Whatever the driver is, that awareness is raising. But people are still at a very kind of early stage of really knowing what to do about it. And that's, how to roll up their sleeves, how to define things, how to structure things. That's where the development finance world and EBRD and the other DFIs have like a huge role to play in helping the rest of the financial sector, because they've been in the climate business forever, right? And I also think the development finance world is probably 5 years ahead of the regular Main Street investors in terms of figuring out in a very substantive and detailed way, how do you define resilience? One of the things that comes up and is in the CBI principles, resilience of an asset or resilience through an asset is something that the development finance community kind of care a lot about. The average investor buying a bond may not actually, that may be interesting, but that may not be decisive in terms of what they're going to kind of be looking for. But having that toolkit developed in the development finance community is, again, leaps and bounds ahead of Main Street on this, is going to be really important. That's where you're going to start to get understanding among Main Street investors. And that's also where you're going to start to be able to have a conversation with them to crowd in that private capital in places that are more vulnerable, like emerging markets, or Joyce, to your last point, even vulnerable communities in OECD or the US also struggle to raise capital because of their heightened vulnerability, lower credit risk issues. So I think that's a really important thing to recognize. Awareness is high, understanding is low. Part of it, in my view, is because of where we are on the journey. We're kind of in chapter 1, maybe, or chapter 2. But it's definitely something that needs to be bridged.
No, that's fantastic. And I would also say, while you did tip your hat to the development finance institutions, and I totally agree, they've been in climate forever and they have a lot of role in moving us forward, as we see from the extraordinary leadership that EBRD, for instance, has shown in resilience. There's also a really major role for partner organizations like the Climate Bond Initiative, who was so really unique in the industry in putting together the climate resilience principles. I mean, who would have thunk it? That was very early. And also now a relatively new entrant, the Global Center on Adaptation. I mean, setting the agenda, Maria, is really a part of making not only the awareness much higher for many of us, but also galvanizing action. And I just wondered if you had anything extra to add here around that agenda setting, and especially when it comes to awareness for action, that not only what to do, but how to do it, how to go about getting the work done.
Sure, Joyce, and I'm going to mix things between the question that you just asked me. Yes, we as the Global Center of Adaptation, we took all the activities and recommendation of the Global Commission on Adaptation, and bring them, try to take them into a path that accelerate action for adaptation and resilient investment. And we do a lot of advocacy at the very high level, working with ministers, working with development banks, partnering with them, and try to accelerate that action. And we do a lot of research around it, and that's why I come again. We put out this report on Green Bond for Climate Resilience and a practical issuer guide with CBI and CPI. We will launch we launch a couple of flagship reports on state of trends of finance, of adaptation finance. But we also want to help implement. And as a solution broker, that's what we do. We partner and we identify those that are already working in developing a solution and bring that solution into that country, that private sector client that it's needing that solution. And for that, again, each actor within each stakeholder in the financial system has a role. So we have the central banks that should, there's the NGFS that is starting to do methodologies for stress testing so that central banks can integrate climate risk into stress testing and in their macroeconomic analysis. We have TCFD that Stacy has been mentioning, and how financial institutions and corporates and basically all actors of the financial system start assessing, managing, and disclosing those risks to create the opportunities. And that's where we bring also the international aid to help them structure and create this capacity to identify projects. The fact is that it's very difficult to identify a resilience project because first you need to do a vulnerability assessment of the problem that you are having and how you build resilience or how you make that project adapted to climate change. So there's a lot to do there. It's already mentioned the part of metrics. Metrics, it's so complicated, but it's so country specific. Thank God we have certain principles and standards to start working around it. But then again, it is about making these metrics transparent and more standardized among projects. But I'm going to stop here.
Yeah, and by the way, Maria, you've mentioned several times these really important documents, the green bonds for climate resilient state of play, the roadmap to scale, and the guide for issuers. These are absolutely how-tos, and I have been very edified by them in the few days that they have been out in executive summary form. And Ujala assures me that there are swap card links that will be available to anyone on the line listening in. So, but Isabel, you've been set up now many times as a real market maker. And I wondered if you could share a little bit more about that in terms of your role, of course, serving your constituents, but also, as you can tell, in opening the world's eyes to what's possible around resilience investment through your green resilient bond. What kind of tools do you think are really important for that, maybe specifically around metrics or other things? And what do you see as your next step in this role as a market maker for resilience investments?
Thank you for the question. Well, I think that we've been working both individually through our climate resilience bond, but very much in partnership with GCA, with CBI, with through the green bond principles to try and really focus on what the issues are that people need to use. And one of the tools that we've had is through impact reporting metrics. And there's an impact reporting working group of the green bond principles. And we put together the climate resilience metrics back in, I think it was December last year that we launched them. And they're on the website for the green bond principles, so they're easily accessible to people. And they were trying to speak to both a definition, but pointing also to other bits of information like the CBI's principles. But, both the definition, trying to explain the process-based approach, which is obviously very critical in relation to climate adaptation. So it's a bit of a different thing. And as Maria was just pointing out, the starting point has to be that you have some understanding of what the vulnerabilities are, what the risks are, some sort of quantification of the risk, the negative impact, and the proportionality of that. And then we tried to focus on, there are different ways of doing it. So we've basically defined it in relation to climate-related hazards, by which we mean, temperature-related or wind or water-related or land-related. So land-related being things like landslides and subsidence and avalanches and soil erosion and degradation, which obviously has had linkages also to the pandemic. But, water, obviously flooding and droughts and various different things, and then typhoons and, wildfires. So all the different aspects, and looking at the outcomes of projects that you would have. So how you're reducing the damage or disruption caused, and how that might be assessed. So in relation to those major hazards, we've put out certain kinds of metrics. So for instance, in relation to temperature related, a lot of the things that people have been doing is looking at grid resilience or, and therefore you can focus on transmission, distribution and storage in terms of megawatt per hour, or, if you're talking about reduction of number of wildfires, you can look at the area damaged in kilometers squared. So all of these tend to be done against the sort of counterfactual of what if you did nothing. So what is the expected damage that you would have had before you took the measures, and how that would be. So, we've done lots of sort of quantitative metrics in relation to all these different things. And then we've got some other metrics that actually speak, really, Joyce, to your point about the effect on people, the social aspect, the sort of damage that it's caused to individuals. So you've got, how many people have now got thermally safe conditions, or, resilient energy systems, or aren't getting flood-related infections, and so on. So, there are the social impact metrics as well. We also provided another possible way of looking at reporting. So you could do it by sort of sectoral approach. So, the impact on health, or the impact on infrastructure, and so on, and how that may translate. And I think those are the ways in which we can try and increase understanding and awareness. And EBRD has, since we actually published those, used it for publishing the impact on of our climate resilient bonds. So they appear in our sustainability report, which is available from the website there. And we try to put things out in a way that other people may find helpful to use, whether they're an investor or not, or they're another issuer. And I think then with our experience of dialogue with other investors, we're really able to start to see how we can help other issuers come and push forward to do things. Mostly to date, discussions with regions and so sovereign, sub-sovereign level, but always happy to discuss with anyone. So that's sort of been the approach we've taken so far. I don't know if that's helpful or not.
Super, super helpful. And it makes me have a gajillion questions for Nazmira because I'm just so interested to know, like, what is your response to this kind of set of assets? Does it actually improve your prospects in helping your colleagues see the resilience benefits of the investments he's making, for instance? But anyway, I'd love to hear more from you, Nazmira, on any elements of this, and particular, perhaps something about your investments in Africa, because it would be very helpful to have some geographic specificity to some of the concepts that we're bringing up here.
Joyce, I think, to answer your first question, yes, it helps. It helps to bring it alive for him. It helps to hopefully, next time he's thinking about a climate bond, to think, oh, maybe we should find resilience bonds specifically as well, which hopefully then starts to create a demand, because that's what you ultimately want. But I think one of the big issues is we need to skill people up. Is that I think that resilience bonds are actually more complex in terms of understanding what they are, monitoring them, than typical historical green bonds. And therefore, I think that there's a skilling up required, which will include the banks, because I think you have to skill up issuers, and the way to skill up the issuers is to skill up the banks. So when a company is looking at how they fund their capex going forward, and they have to deal with the impact of climate change and mitigate for that, I think this has to be a viable option, and I don't think that's well understood. So I think it's both sides of this. It's both the buy side, the investor side, but it's the sell side as well, because unfortunately, I think Isabel's level of knowledge is not widely spread at this point in time from the structuring side either. So I think that would be my first point. And within that, I think one of the things we're going to have to do as a business is get to grips in a much more granular way with monitoring the impact. So, we're doing this in terms of our, there's a massive exercise going in across asset managers at this point in time around how do you measure carbon reduction. And but now we're talking about resilience. We're going to have to get to grips with what that means. I mean, we have no clear idea on how we're going to measure carbon reduction or transition plans. But now this is another set of complexity that's going to be added into it. So I think the toolkits that CBI has just produced for issuers, I think is excellent. And I would urge you to produce a similar toolkit for investors in terms of the questions we should be asking.
That is a good challenge. I think you're probably going to be invited to be on an advisory panel soon to create such a thing. So that is really fascinating. And something you raised reminds me of some of the introductory remarks that Stacy from Climate Finance Advisors mentioned, because she pointed out that the Task Force on Climate-Related Financial Disclosure is one trigger for more resilience investment. And one thing that TCFD does is it basically says, shouldn't every investment be investigated for the physical and transition risks that it faces? And by asking that question, what are the physical risks of these investments? In some ways, it almost demands that every bond has a resilience potential. So I hear you saying, Nazimira, it's harder to make this subset of the trillions of assets under management for resilience. And we've all said that, right? The knowledge isn't there. The metrics aren't there. It's a brand new area. But on the other hand, some part of us also knows that resilience has to be part of every investment we make. And I guess I'd love to just turn to Stacy for a moment and hear you talk a little bit about that, perhaps in particular from the perspective of the United States National Infrastructure Bond. I really gave my US creds away a moment ago when I said something about miles, not kilometers, but it is an interesting moment. Like, what are we talking about when we think about resilience investment in the context of these extreme events that communities are facing, even as they welcome new infrastructure dollars?
Yeah, Joyce, I guess I would say, yeah, I mean, I think that in some of the work that we're doing for clients, this, aha moment, so the awareness is there, and then they're looking for understanding, and they understand. Sometimes people are coming to us not because they're being driven by the potential for disclosure on the horizon or, some stakeholder around the table, but they actually do understand they might have some financial value at risk given kind of the portfolio of investments that they're managing or investing around. And that is slightly different than the drivers that a lot of us are used to in terms of climate investment. A lot of us are used to drivers that come from governments or policymakers, or maybe some small set of, impact investors who are looking for specific things. But we're starting to see investors really start to kind of think of climate risk. And I think this is partly because of, people are kind of simply kind of observing the changes and the impacts from kind of climate change as losses and damages to investments, right? But they're not really sure how to address them. And so I think from that perspective, those folks are quite interesting to talk to, because they're really not coming at it from an advocacy perspective, but coming at it from a risk management perspective. It's a credit risk, it's a financial value at risk perspective. And to the extent that that's true, they start with everything might have climate risk, not just the green stuff, or not just the stuff that somebody says has like an ESG angle, but everything. And so I think that that's, there's a confluence of things coming around at this moment in time. And in maybe 5 years, we'll see kind of how this all comes together, the policy side, the regulatory side, the real efforts in certain places by holders of the public balance sheet to address climate risks with their public balance sheet through blending and blended finance and things like that. But generally speaking, that's like that's almost like part of the climate movement and part of the climate story. This issue that climate is actually a risk is new and important, and could be a really important driver. One way to kind of figure this out, and when you're talking to investors, is where is the question coming from? Is it coming from the climate and ESG group, or is it coming from the CFO's office or the credit and risk office? And we're seeing more of those questions coming out of the credit and risk office. There's some things that, again, kind of the development finance world and some leading investors have been involved in that get the conversation going. But we're at, like I said, we're at early stages in terms of this understanding and having the toolkit and things like that. One thing I'll pick up on that Nazmira mentioned that I think is absolutely critical, which is, we need legions and legions of people who understand this issue, and we don't have them in all places. And so, that's a really important, in addition to the kind of bridging the gap between awareness and understanding, having the tools to be able to define resilience, to manage climate risk, because we're not going to get rid of it. And then, doing it in all asset classes, in all kinds of investment, investor houses, banks, all types of issuers. That's a lot of work, and that's a lot of people to train up and get them kind of focused on this. And that's a really big point. And Nazmira made it in her last comments. I think it's important to reiterate.
Stacey, may I jump to one of your points, because you nail it when you say now it's being considered by the by the risk departments. So this is kind of the point where the needle moves, because if the risk department stop an investment just because they are starting to perceive that the project itself, a huge investment, has a climate-related risk embedded, there's what we're talking. And this is how important it is that rating agencies start asking how companies are assessing the risk and are managing it. It is so important also, for example, the work that the IMF is putting out there on the surveillance and the policy recommendation they will put out on their surveillance report in countries on how exposure is a country to physical and transition climate risk. And then from there, start supporting central banks, private sector, financial regulators to start thinking about how they will manage those policy recommendations and make it happen. The thing is, once the risk department understands that there's a risk, that risk creates an opportunity, a business opportunity. You change the way you lend, basically. And I think this is the trigger.
So this is so interesting because, Nazmira, you pointed out a few things that we actually have some requirements around some of these triggers that we're talking about today, but there also are some places in the world that make this decision-making particularly hard. Would you like to just table some of that for us? And by the way, we've gotten some fantastic questions from the audience, and many of you have answered a lot of these questions, but I am going to be coming back to the question of modeling and how we can help to overcome a real barrier that exists in the marketplace, especially for developing countries, in terms of limitations on modeling that help them to really understand what the data suggests for resilience. And I think that the island nations are a particular context for that. But Nazmira, do you have some suggestions around this concept of where we turn for the directive for resilience investment?
Well, I think I just wanted to go back to Stacey's point, Joyce, which was how this affects all investments. So I think for a lot of people listening to this, they'll be living under SFDR. And SFDR, which came into play in March this year, the minimum requirement for funds that are widely distributed in Europe is Article 6 funds, and that requires investors to consider and price the externalities, the governance, the social and the environmental externalities. And I think that is still a work in progress. The obvious environmental risks are priced, and now this discussion around resilience is what forces us to think further ahead and down the pathways of what could happen. So I think you're right, Stacey. It has to be mainstream because that's what the legislation in Europe is already guiding towards. On the island nations, so I had a really interesting conversation with the finance minister of a small island nation recently, who's desperately trying to deal with rising sea levels. And if we think about the sharp end of the wedge for resilience investments, I think if you're a small island nation, that has to be it. And as we think through whether these investments can ensure the viability of the island long term, and if the answer is yes, then how is that funded? I think if we think through the next 10 years, that is something resilience bonds have a massive role to play in.
Great. Another really important bar has been set here for all of us to invest in that. And I guess I would like to turn, we have 5 minutes left, and there is one specific question I think that Isabel, you could help us with, if you would be so kind. And this relates to the capacity that I just mentioned that is lacking for many countries, but especially the lower income countries and least developed countries, to help structure their climate resilience projects based on potentially huge gaps in data and modeling. So what can be done to really avoid these deficiencies and leapfrog into the urgent resilience investments that are needed? And how have you at EBRD helped your members to overcome some of those deficiencies?
Well, I think that a lot of the discussion has been about some of the analyses that we're starting to see, partly in relation to TCFD and TCFD reporting. So for our geographies, we've already started working with others, which means inevitably also with our clients, on what are the prime vulnerabilities in particular geographies that we need to be addressing. And that's what we're reporting for the generality of the portfolio, but obviously it becomes very important when you're referencing a specific investment. So, thinking about an investment in a water-stressed area and what needs to be done in relation to that particular investment in order to ensure that it's not vulnerable to current or future changes. So, I think it's interesting that, for instance, when people say, well, we're starting to focus on Paris alignment in everything we do, Paris alignment's not just the temperature goal, it's also about the resilience and adaptation aspect. And I think that those kinds of scenarios that we're starting to see are both current but also future scenarios, some of the more extreme different events that will be happening that we can start to assess these projects against are very much the kinds of things that we're working towards. So we've done some in the report that we will soon release. We're continuing to incrementally increase the degree of reporting that we're doing about specific geographies and asset types that we're looking at and certain vulnerabilities. And I think that the national adaptation plans is also another part of where companies and others can go to try and fill the gaps. So I think, Maria was talking about that earlier, and I think that's going to be very important in certain geographies, because at sub-sovereign level, it's going to be quite difficult for certain types of entities to really grapple with these things. And it may be important. Even in developed countries, we were talking last week at a panel on Switzerland and the effect of climate adaptation on or climate risks on mountainous areas. And obviously in one canton, it's going to be very difficult for them to do the assessment, but you can have national adaptation plans and then work for other cantons who may come together and be able to actually scale the assets as well, that could underpin something like a climate resilience bond. And that can drive things forward. So I think the mixture of understanding and expertise that decision makers overall in the geography are going to need, and that can be utilized by others including in their individual reporting.
Wonderful. Well, thank you so much. That is a great place to end. And we've been so inspired by this extraordinary panel of women resilience leaders. I'm going to ask Stacey to give us the last word, 30 seconds. What is one thing you plan to do to scale up the ambition and impact of resilience in the 2020s, given the extraordinary urgency of this issue?
I think the mandate to just start kind of training people and building capacity in all walks of kind of the financial sector and development is key. I mean, we really do need kind of legions and legions of people kind of addressing this and all kinds of jobs in all kinds of areas. This is not just an incremental thing. Kind of, this is actually going to be the thing that defines the next generation. It'll define the end of our lives. Most of us are kind of in our middle of our career, kind of, and this is going to be the rest of our careers. But the people coming up behind us, this is going to define them and define their worlds. And we need to arm them with the right ways of thinking about this, give them hope that they can address these issues in a whole bunch of different ways. So I think that's.
Thank you so much for the hope that all of you broker. Nazmira, Maria, Isabel, Stacey, we are very grateful for your work. And thank you to the Climate Bonds Initiative. Take care, everyone. Bye-bye.